Patrick, I kind of feel like when the producer says powder up, I think what they're trying to say is, JG, Patrick, stop losing hair because it's getting shiny up top. I think that's what they're saying. Ladies and gentlemen, welcome to another episode of Rein It In. It is going to be fun, and even though we only have 3 sticky notes, they are quite deep in topic of conversation. First of all, we're going to talk about the rising bond yields and what it means to investors and their mortgages as bond yields rise. Secondly, we're going to talk about mortgages hitting their trigger rates and how the banks are using negative amortization to deal with that. And number 3, we're going to talk about the ironic side of inflation, which is definitely going to be fascinating. So welcome to Rein It In. Stay tuned. We're in for a ride.
So JG, before we get started, always we're reaching out, asking people to subscribe, to like, to comment, to engage, to build this community. We are trying to grow this channel. We want to grow this channel. We want to grow this community. And one way to do that is to ask politely, please subscribe, comment, share. Let us know how you feel about what we're doing. And some of you have been doing just that, commenting and sharing. And the channel's slowly growing. But JG, we need you to like it. If you're listening, like it right now. Like it right now.
Pause, like, comment, hit the bell, and we'll see you in the show. All right, Mr. Francine, let's dive deep into our first topic of the rising bond yields. Now, let's just set the context, Patrick. Number one, I'm going to put up a chart here real quick on kind of where they were and where they are currently, but we've had quite a sharp increase in bond yields. But first, let's kind of talk about why that's important, especially for us real estate investors. We're investing in real estate. Why the heck do we care about bond yields?
Well, the 5-year Government of Canada bond directly influences the 5-year fixed rate mortgage. And what's been happening over the past several months actually is it's been uncharacteristically volatile, and it goes up and it goes down. So what does that really impact us? It affects our fixed rates. And so we're going to start to see, based on what the show we're doing today, we'll probably see a tick up in the 5-year mortgage rates next week. And, it's interesting is that this just literally happened, as in they ticked up within a 2-day period to, I think, 3.30. I think you have a chart on that. But ultimately, that affects the 5-year term. And so now people are, okay, do I got to rush out? Do I got to go get pre-approved? Can I get something locked in before next week? I don't know that this can all happen, but that's the bond and the effect of it.
Yeah, and it's interesting because a lot of people see that the Bank of Canada is raising interest rates, at least they have been for the last year. And that's kind of funny, Patrick, right? This has only been happening for a year. It kind of feels like this tornado has been happening for a long time, but they've only started raising rates roughly about a year ago, maybe 13 months. So the point there is that the Bank of Canada's rate, the overnight rate, that is not, I just want everyone to know, that is not what determines the 5-year fixed rate of mortgages. It's the bond yields that determine the 5-year fixed rate of mortgages, but variable rate mortgages are determined by the overnight lending rate, which is set by the Bank of Canada. So I just want to kind of show everyone the difference between a variable rate, where it comes from, and a fixed rate, where it comes from. This definitely is going to have an impact, but I just want to kind of take people also back a little bit down memory lane. If you look at the chart we put up here, like you said, Patrick, it was at 3.3% earlier this year. Then it went up to 3.4. It went all the way down to 2.8, and essentially its trading range has been between 2.8 and 3.6. And as you mentioned, that's quite a volatile range for this bond yield because typically it's quite stable. So this has been happening, and 3.3 is definitely towards the upper end of the trading range. It was at 2.8% for the last give or take about 2 months, somewhere between 2.8 and 3. And as a result of that, mortgage rates had come down. You started hearing about investors being able to get mortgages at 4.5, at 4.25, at 4.3. That's because the bond yields came down. Now that they're starting to tick back up. By the way, are they going to come back down? Yeah, most likely. But this is always creates a little havoc in the marketplace, Patrick.
Well, I think there's a couple things that we need to consider with all of this, right? Which is, we see the volatility, which speaks to what's going on in the general economy, the general marketplace, the feeling of discourse, the global issues that are happening. And there's a lot of uncertainty in there. So there's a lot of things that will affect bond yield, certainly what the economic outlook is. And I shouldn't say everybody, Many are saying we're going into a recession or we're even in a recession. Others are going, no, we're teeing up for a soft landing in the next year, 18 months. So there's that uncertainty. So that will actually affect these bond yields, as will, for example, monetary policy. But then we look at the market and all of a sudden we see some inflationary pressures. And so we got investors that are, some are fleeing to what they would call safety in a government of Canada bond, and then others are getting out. And it's kind of all over the map. So I think this whole dynamic, this volatility will continue. And JG, we're already seeing what's happening. If there's not enough inventory because all of a sudden buyers are feeling pretty optimistic. Oh gosh, 5-year rates, 3-year rates, they're not so bad. Like you say, they're in that 4.5% range. And I can handle that. So they're going out buying. Now, as of next week, we see this influencer, which we talk a lot about. Interest rates are an influencer. And I think that if we kind of look over the past 3 years, we see what kind of an influencer they are on the housing market. So investors, you have to consider and think about where you see interest rates going into the future as well. And this is going to be based on bond yields in this case.
You talked about, this isn't even a sticky note, but I'm adding it in as a bonus, Patrick, because you talked about the R word, recession. And, it's so funny because I'm going to make a prediction right here, right now. I bet you here's what's going to happen. I bet you that they are going to, because often what happens is, if in case people that are watching this don't know, often, as in every single time numbers come out, those numbers get revised every time, all the time. All the numbers get revised. They first come out, then all of a sudden, a month or 2 or 3 later, sometimes it could take 6 months later, they revise those numbers. I bet you, Patrick, what's going to happen is in a certain number of months, maybe even a certain number, like a year from now, they're going to come out and say,
oh, we've revised those numbers. We were in a recession, but it's over now.
I bet you that's what happens.
Yeah, it could be. I think when we look at Canada, let's just look at Canada in what's happening and unfolding. So we look at GDP, which is a lagging indicator, even unemployment, there's a lagging. But when we look into the future, we want to consider a few things of those leading indicators, for example. Now, I talk a lot about consumer confidence and that it's at an all-time low, which means people are spending less, which will, in fact, slow an economy down. What we're hearing as an example in the U.S. is a lot of these big corporations, these tech companies, literally laying off thousands of people. So as much as we hear that the U.S. economy is being quite robust, if you kind of look under the hood, if you will, we're seeing that really isn't the case. But now, why do I bring that up? Well, if you look at Canada, we're not getting those kind of announcements in any way, shape, or form. We're hearing more that I need more people. We need to do more. So if that's a leading indicator, we're not looking at unemployment spiking anytime soon. We will see it. We talked about this in the past, is that if it goes to 6.5%, we'd actually like that. The headlines will be, oh my gosh, the world is coming to an end. But if we know that the range of 6%, 6.5% is not out of whack for unemployment, then we look at that and go, no, we're still good. We're healthy. Ignore that headline. So the point of all of this is when we look at what's happening economically in Canada, if we look at leading indicators and we look at production and we look at manufacturing, all of those things, it's not great, but it's not bad news. Nothing there yet. So that's why I'm being cautiously optimistic. And to your point, I think in 6 months, we could see that announcement being made is that, okay, we're all good. We're good.
Yeah, exactly. Now, I will say this though, Patrick, let's come back to bond yields for a second, because I think investors watching this show, they're asking themselves, what do I do? What do I do with these bond yields? Do I rush out, get a mortgage now? Do I go fixed rate? Do I go variable rate? Where do I go? And I think let's first have the conversation about fixed versus variable. That's a conversation you must have with your mortgage broker. And the reason is because a fixed rate mortgage comes with very different terms than a variable rate mortgage does. Even though you might pay a little more on the variable side today, you might end up over time, depending on where you think rates are going to go, pay significantly less. And the cancellation penalties and the other terms tied to your mortgage can be better on the variable side. So it really comes down to, as an individual investor, where you're going with your game plan, where and when you're looking to exit your pieces of real estate in your portfolio. That all has a place to be considered as part of the overarching conversation. It's not just easily said fixed or variable. It's more complicated than that. And that's where you should engage, like a investor focused mortgage broker that understands the game, not a normal banker that's working at your local TD or BMO They don't know this stuff. They're just going to sell you what they have on the shelf. But an investor-focused mortgage broker can make that determination of exactly should you go fixed, should you go variable. That's my advice, Patrick.
Well, I think we can't overstate that. We say this almost to nauseum, but people still don't hear it. They want to go what they think is this path of least resistance, and they sit down with the bank because they just happen to be there. I don't know. Work with a investor-focused mortgage broker. And JG, we've got trusted partners that they actually sit down, they do whole planning sessions around it because that's how important it is. So I'm going to say it again. I'll keep beating the drum. Investor-focused mortgage broker, and then start to put a plan together. And then you understand where you even sit in the bigger picture. So I think that they literally are on the pulse of what's happening with mortgage rates, with bond yields, fixed term, short term, variable rates. They're dialed into that. So these, us having this conversation, we can give you that overarching, but to get into the minutia of it, you have to work with that investor-focused mortgage broker.
Before we move on, I just think this topic is so important because, as you said a while ago, it is for us. Interest rates are an influencer. And they're a part of the decision, but they're not the fundamentals of the real estate market. They influence the real estate market, but they're not the fundamentals of the real estate market. If you want more on that, you should definitely come out to one of our events at the Real Estate Investment Network. Come out to the upcoming Accelerator Conference as an example. You'll learn more about that. But what I'm trying to say here, Patrick, is a lot of real estate investors or people who want to be investors, they make these buy, don't buy decisions. Should I get into the market? Should I buy another piece of real estate? Yes or no, based on today's interest rate. But that's a 20-year decision. And those interest rates are going to go up and they're going to come way down and they're going to go up and they're going to go down in your 20-year period. But sometimes, Patrick, literally people delay their entry into real estate by many, many years, if not ever get in because of these interest rates. I think that is a big mistake by real estate investors.
Big mistake. Big. Huge.
It doesn't have that much of an impact over the course of your entire career as a real estate investor. And you're in the game for 20, 25, 30 years. Man, your best friend is the time that you're in the real estate market, and you shouldn't let interest rates determine that.
I just want to expand on it one more let's keep hammering on this a little bit, is that interest rates are an influencer and they're very emotional. And that's because it affects those first-time home buyers, next-time home buyers. When you're talking about buying a home for your family and, setting up camp, if you will, and having that place that you can call your own, that's a very, very emotional conversation. And interest rates really affect your decision-making process in that, because you're looking at your income, your paycheck, your household income with who else is going to be there. Am I going to have a roommate? Whatever the conversation is. As investors, we got to get out of that emotion, out of those headlines, and just do math. Full stop. Look at my strategy, look at my tactic, do math, take the emotion out of it, sit down with somebody, who is licensed as a investor-focused mortgage broker, realtor, accountant, whatever that might be, because you're putting a plan together. I can't overstate how important it is to get out of those freaking headlines that are speaking to first-time home buyers, next-time home buyers, and the general kind of retail populace, if you will, the retailer or the realtors, for example, who are trying to get deals done and there's no inventory. These are all emotional things, and we got to get back into the real data.
100%. All right, Patrick. Bond yields and rising bond yields covered. Sticky note number 1, complete. All right, sticky note number 2, we're going to talk about how the mortgages are hitting their trigger rates and what the banks are doing about it. So first, again, let's set the context, Patrick, which is these variable rate mortgages, they essentially have a range where if the interest rate stays below that, that's called the trigger rate. If it stays below that, your payments are the same. But if you cross that trigger rate, then your payments change, meaning they could jump up significantly. That's one of the downsides of variable rate mortgages. And someone who has a fixed kind of household income, sometimes they can't handle that, rightfully so. And as a result, this can create a lot of havoc for people. Now, a lot of people a lot of banks are now hitting those trigger rates. A lot of mortgage contracts are hitting those trigger rates and have been over the last little bit, but the banks aren't actually increasing payments. They're doing something different. And this is quite unique. And I noticed it on one of my mortgages.
Well, I think there's a few things to consider here. I think the number is actually 75% at least of mortgages out there are hitting this trigger rate, this so-called, or what they refer to as a trigger rate. To your point, all of a sudden payments aren't covering interest. But here's the interesting part of all of that. So when we look back over the past 2 or 3 years, of course, we saw this housing market frenzy. We had Bank of Canada, Tiff Macklem, governor, look into the camera 3 years ago and go, rates aren't going up for a long time, a very long time. So we joke about that all the time. Like that will live into his profile for, it'll live online for a lot of years. But the point is this, now they in fact did the opposite of what he said they were going to do, and they more than doubled. Did they not just triple? Like they're up a lot. So the point is this, when we look at what happened with payments, the banks are now hedging their bet, JG, because here's what they're doing. They're kicking the can down the road, and they're not actually passing the increases on to the owners of those property, the retail, to the homeowners. Why? Well, guess what? If they do that, they're going to start foreclosing. They're going to end up with a bunch of real estate on their books that they don't want. So what's literally happening is they're extending amortizations. They're not upping payments. And that's not the case for all banks, by the way, but a large portion of them, like 80% of them, are just kicking the can down the road, which they don't want the real estate. They don't want to have to foreclose on the deal. But here's what's happening for the homeowners. Guess what? They're living into a space where they don't pay down their mortgage at all. And as a matter of fact, if they go into this amortization and things don't change, they could literally owe more money in 25 years than when they started. What? So it's not a good situation for anybody right now, but I understand why the banks are doing it. And I believe that this is going to, it's an indicator of something here, JG. And I know this is a little bit long-winded, but I think there's an indicator here that the banks are going, we're hedging our bet and thinking rates are going to come back down. That's what I think.
Well, that's interesting, and you very well might be right about that, Patrick. And I think it's fascinating that the banks are using this tactic, because I think if you're the average homeowner and you're on a fixed household income and you make whatever you make, 100, 150 grand a year into your household, and you have a mortgage, and like, do you want your payments to double, or do you want to extend your amortization? And your statement about owing more in 25 years, it's a little dramatic, Patrick. But because this won't last forever. But for now, it is a bit of a short-term fix for these banks and for the people. I think it's kind of fascinating. But I had this happen to me because I have a mortgage. I forget how many it had. It had 23 years left on it, I believe, if that's a number. And I opened up my statement and it says, you now have 27 years left. And I'm like, how the hell did that happen? But this is exactly what happened. Is that's what we mean, folks, by negative amortization. They didn't change my payments, which is not a bad thing for me, because at least this way I still retain my cash flow in that particular investment. But now I have to pay it off in 27 years instead of what I had for 23 years. But that will shift. That doesn't get fixed there. That'll shift as interest rates start to shift back down, and then we renew those mortgages. So it's all kind of interesting, Patrick. And I think it's, have you ever seen back in the day, did they do this back in the day, Patrick? Or is this a relatively new tactic they're using?
I've never seen it. I'm not saying they didn't do it. It wasn't certainly public like it is today. It wasn't a big topic of conversation. We didn't have a social media back then. We didn't have actually the bank policies that we have today, the demand, all of that. So it's a different time. But I think there's a few things to consider. Number one, not all banks are doing that. And I'm going to make this point. Let's work backward from how do we look at it as investors. So first off, the banks are doing this for a couple of reasons. I think that they look into the future and they go, rates are going to come down and we can get people back on track. I don't think it's good publicity if all of a sudden they're foreclosing on a bunch of real estate that they now hold and have to get rid of. I think that's bad news. If you look at people that are struggling literally now because they did in fact see their payments double or more, that's where the opportunity lives. Now, that always sounds a little bit like, oh my gosh, we're taking advantage of people that are in trouble. And I want you to shift that thought process into, these individuals are individuals that investors who are savvy, sophisticated, who are thinking through things can go in with an attitude, how can I help you, and actually put deals together. It's a way to look at it and say, this person has a problem. He created it, the banks created, or she, whatever, the family created it. At the end of the day, forget about whose fault it is. I've got a problem, and you as an investor can help me out. So as investors, we want to see these things and be able to grow our portfolio based on what's happening within the economy. That's how we have to approach it. I'm surprised that there isn't more happening, but I think that in 6-12 months, we're going to see a lot more of it happening. We've talked often about the creative buying strategies that we educate, we teach, Barry McGuire, and the creative buying strategies programs that he's done. This is the exact time you need those skills and those tools to take advantage of what's happening in this marketplace. So that's what I think is going on. I think it's also a PR move, again, for the banks.
For sure.
With all that's happening, you start foreclosing, and boy, oh boy, people are going to be pissed.
The banks are not equipped to own real estate. They're really not. They don't want this real estate, and that goes for, we have a very low delinquency rate right now on mortgage rates. We just published that number a couple weeks ago, I think it was, Patrick, a couple episodes ago. I remember pointing out, in Canada's delinquency rate on mortgages is very, very, very low. And this is a big reason why, because we're just pushing out the amortization, which is helping to make sure some people that are on that edge don't default on their mortgage. But you're right, Patrick, about sophisticated investors. Many of those watching this show, that's why we're hosting that upcoming event we're doing at the Rapid Cash program with Barry McGuire in Edmonton, is to teach some of these advanced strategies so that investors can become sophisticated investors. And as a result, they can be problem solvers and help these families that do end up getting into trouble. They still need to get out of that trouble, and us investors can help them with that.
Mm-hmm. And quite frankly, JG, I'm really shocked at how many people are sitting on the sidelines waiting for something to happen, as opposed to being in action, looking for deals, creating deals, looking for opportunities and creating opportunities within the circumstances.
It's because of actually what you just said, Patrick. You just said, you actually just said something interesting. You said there's more of this coming down the line. There will be more deals, but investors somehow, especially the not so sophisticated ones, or the ones that are just starting out, they're always waiting for that better deal. And when you keep waiting for that better deal, there's always a better deal, guys. There's always going to be a better deal down the line. But you know how much money you're leaving on the table by not getting into this deal? You just got to look at that deal and say, if this deal works for me, awesome, let's do it. Let's pull the trigger. If you wait for, there's always a better deal to be had. There's no doubt about that. And there's the same way, there's always a better deal that you missed in the past. And you're like, shoot, I should have done that deal. And you really got to take those two out of the equation as an investor and say, what's in front of me right now? And is that a good deal? If it is a good deal, then pull the trigger and move forward on creating your financial future, because waiting is the worst tactic when it comes to investing. That's for sure. All right. Topic number 2, covered in detail. All right. Topic number 3, we are going to discuss the ironic side of inflation, Patrick. And I'm just going to let you explain the context on this one, because this is kind of funny. The very problem we're trying to solve, we seem to be making it worse at the same time.
Isn't it hilarious, though? We look at what's happening with inflation. April numbers come out. We actually ticked up in terms of inflation. And JG, I've said many, many times, inflation isn't going away anytime soon. As a matter of fact, we may see another tick up. And I get that everybody's going, well, no, energy prices are coming down, oil prices are falling. I'm going to stay true to what I still believe my thesis is around oil prices, which will in fact increase inflation a little bit more later this year, because oil is the thing. So let's just slow down and go back a little bit to what we're talking about here. Is when we look at inflation, we saw food prices go up, like literally, I think 8 or 10%. It is remarkable.
I'll put up a chart now. So cost of food in Canada, April 2023, 8.3%. Now, the trend is decreasing, but still up 8.3%.
You still have to look at base rate. It's up 8.3%. I mean, that's nuts. Okay, so that aside, then we look at the big one, which is almost 30%, I think, of inflation, of our CPI, which was shelter costs, rent, and oh, by the way, interest payments on your mortgage. Isn't that interesting? That's the ironic part of it. Here we are raising interest rates, and I'm going to say it again for 100 times. I'll go down in history of being absolutely right or absolutely wrong, but I'm telling you right now, raising interest rates is not going to affect our inflation numbers. I just don't believe it. It makes no sense to me that it can. It could slow down housing, no doubt about it, but it's not going to slow down inflation. And what's interesting about that point is that as they've increased interest rates, it becomes a part of inflation. So when we look at shelter costs for rent and we look at cost of carrying a mortgage, interest rates play into that. I think it's 30%, almost 30% of the cost of the rise in inflation. So it's all to say this, is it's just so ironic.
Don't you think?
That the thing that's supposed to fix the problem is part of the problem.
As the other thing too is interest rates are also push up higher interest rates, also push up higher rents, because the more expensive it is to purchase, well, then people decide, okay, well, I'm going to rent. That creates more rental demand, and as a result of more rental demand, rental rates go up. So it is interesting, and I think one of the biggest fascination for people to understand is that inflation truly is a loop. It's a hyperloop, and it kind of feeds on itself. And that's what you're saying, Patrick, is that as we raise interest rates, which is supposed to counter inflation, that contributes to increasing inflation. But it had definitely, no doubt, has slowed down the real estate market, Patrick, in terms of many different how you look at things. Many factors of the real estate market has slowed down, which is a huge part of Canada's GDP. But doesn't mean it has totally solved the inflation problem, as you mentioned, because I'll put up another chart here, and month over month inflation is now at 0.7%. And if you look back to February was 0.4, then March was 0.5, now April's 0.7. We're now trending back up because we were trending down. We were trending back up, and year over year inflation is at 4.4 as of April 2023. And in March, we were at 4.3. So essentially relatively stable there compared to where we were last year. At this time, we were in the 7.5s and 8 is where we were at this time last year. So we definitely have slowed it down for sure. And we'll see where it continues to go.
You know, it's interesting about inflation, and I'll just throw this out there. Whether we want to share this is up to us. But, you know, ultimately, I was in Kelowna, and I'll talk a little bit about being in Kelowna, speaking at one of the events with our trusted partners, Real Property Management. But when we went out, we go out for dinner, and, you know, historically, JG, if I was going for dinner, and I know our eating habits and our drinking habits, and I would be able to go, okay, well, there's 5 of us going, and $100 a head, you know, that usually is a meal in some form of a beverage, you know, an alcoholic beverage, by the way, not water. I always buy rounds of water for everybody, but in an alcoholic beverage, I used to use $100 as a math. What was your, do you have math around that?
Yeah, roughly that. Yeah, 100, $125 a head. Yeah.
Yeah, right. And 125, you bought a nicer bottle of wine or something that brought that up. Guess what? I'm in Kelowna, and this is not my only experience, but Kelowna and a couple of other dinners that we've gone out for recently. And I'm into that $150, $175 range. And I'm going, what the hell is going on here? Like, my taste didn't go up. I'm not buying more expensive, like different food items, I guess. But I'm looking at it going, holy cow, that's quite an increase. And that's just a kind of a side note, but that's what I want to share.
But you're right, Patrick, and you know what? This is how the economy has slowed down and will continue to slow down. Is we start making different decisions. You know, I'll share a very similar story, Patrick, different but similar. Which is, my wife texted me the other day. I was out, and she says, "Hey, can you pick me up a beverage?" I happen to be right around the corner from Starbucks, so I decided, yeah. So I pull the truck into Starbucks. I order 2 kind of like, you know, medium, the grande size, you know, which isn't their super duper size. It's not their small size. It's kind of in the middle. I ordered an oat coffee, like iced coffee for me. And then I ordered a lemonade thing for her. Dude, $15. Okay. And I mean, you know, we can afford it. And I'm like, and you can afford your meals and I can afford that. And I'm thinking, that's it. I'm done. I'm not freaking spending $15 on 2 drinks. No, that's it. This is my last time I'm stopping here. And that's the bottom line. And I was a regular Starbucks frequenter, but I'm done spending that kind of money on drinks. That's ridiculous. The only way those prices are going to come down is if you stop spending it. So stop spending it.
Well, you know, and I feel the same way about certain things. As you know, my wife, Stephanie, and we joke about my entourage of chefs, but I literally have, you know, people who love to cook that I'm at the benefit of. And so going to a restaurant for a meal that's not as good, but is going to cost me $300, $400, $500, I'm going, no, I'm not into this anymore. So anyways, we joke about it, but that's what's going on.
So inflation is a bit of an interesting, it's still, there's definitely still a question mark around it, Patrick, where inflation is going to go. It's been trending down. We showed the charts. And when I say where inflation is going to go, I think ultimately it's going to continue to come down. But it doesn't mean the Bank of Canada will not have to raise interest rates a couple more times to continue to nip it in the butt.
I've got to say, I don't agree with you. I don't think it's going to come down. It will eventually come down. I mean, 2025? I think we are going to see significant increases in inflation over the next 2 years, I think we're really going to start to feel some pain in terms of just general CPI. From a housing point of view, I still believe strongly that we need to hold real estate. This is not just about, these are times we've never experienced before. We've been through all sorts of real estate cycles, economic recessions, almost recessions. We've been through so many different things. This time is different because it is in fact a global issue. Now, we've been through this, not in my lifetime, not in your lifetime, where we literally have a global issue, and it's even bigger than the great financial crisis of years ago in 2007, 2008, 09 kind of thing, because that was kind of U.S. and primarily U.S. and Canada was at the effect of that. This is far bigger than that, far bigger. So we're seeing things that are happening that's why I'm saying interest rates, I don't think they're going to have a meaningful impact on inflation here in Canada, or would they even in the US, as much as they talk about it. These are a way bigger issue, and I think we're going to experience more inflation, and this is exactly why we need to buy those hard assets, and we know rents are going to go up. What the hell are they doing with 1.5 million people coming into this country this year? Drives me crazy because it's so unorganized and poorly planned. And I actually am starting to feel a lot of compassion and empathy for people who are getting here, can't find a place to live, can't find a job that really relates to what they do and what they have an expertise in, and they can't afford when they do find something. It's like crazy what's going on, and this is all going to impact our economy in terms of increased inflation.
As you mentioned, Patrick, inflation is, it does contribute to your housing prices. As inflation rises, so do the price of your home. And as a result, your real estate values go up. So as a real estate investor, that's why you're saying, Patrick, hold those hard assets called real estate. And over time, as inflation, if it continues to go up, as you're mentioning, Patrick, then you're going to benefit from that as a real estate investor. But I do want to specify one last thing before we end this sticky note, which is it's important to differentiate between holding just any real estate and holding cash flow producing real estate, because the difference is when the costs of your real estate go up, you can increase rents. You have revenue coming in to pay those expenses. If you just are holding real estate for the sake of holding real estate, yeah, there's some benefit to that, but it's certainly not as powerful as cash flow producing real estate. And we're going to have to leave it there, Patrick, and talk about that on the next episode.
Let's do it. So, JG, before we kind of shut this whole thing down, I do want to share a couple of insights I gained while I was in Kelowna, and I spoke at that particular event to investors, and that was part of Real Property Management, bringing together their group of clients and investors to talk about managing a property the right way. I think there's a couple things that we can't step over. Number one, we look at Kelowna, and it seems like it's so priced out of this world, for those who are familiar with Kelowna. Here's a couple things to keep in mind. The market is hot. Jobs are hot. Everybody's looking for people in terms of employment. Like, we need people. That's just to say that the economy continues to thrive. There are so many people moving into that area, by the way, that the demand for housing is incredibly high. Now, having said that, they have about 3.5 months of inventory, and there's a home style inventory. So in other words, if you want to buy a house, they get about 3.5 months. So it's not off the charts in terms of limited supply. It's just a good churn right now, what I'm saying there. But investors, I cannot stress this enough. If you're into that Kelowna market, lots of people are looking at short-term rentals. Be very, very cautious with short-term rentals right now, whether you're in Kelowna or anywhere. A lot of these municipalities are changing the rules, Kelowna being one of them. You need to work with a property manager to understand the nuances of what you can and can't do in a tourist town such as Kelowna. Everybody looks at the big numbers and goes, I'm going in. Be very, very cautious. You need to work with a property manager that understands what is happening in that particular municipality. And I just wanted to share that as we go along. And that's what I would say about RAP. I love Kelowna. It was a great trip, and it was really good to connect with people at a live event, JG, which we keep doing. So come on out when you get the chance.
And Real Property Management's a real deal. They did such a great job on that event, and glad you were there for that, Patrick. Now, folks, for those of you watching, before we end, do know that we're holding one of our virtual events at the end of June called the Accelerator event. And you're going to want to be there because we're going to be releasing some new incredible insights on how to use tools, specifically technology, specifically AI generated tools that can help you analyze deals, trigger offers. It is a big, big shift coming to the real estate space. You're going to want to come to Accelerator at the end of June. Go, just check it out. Google Rain Accelerator event, find the event, register. We'll see you there. All right, folks, thanks for watching another episode of Rein It In. If you made it this far, thank you very much. Please like, subscribe. We'll see you in the next episode.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.